Yo, what's going on, guys? It's Gray here. Welcome back to another video. And in today's video, I want to talk about 5 investing mistakes that beginners make and how to avoid them. I started my investment journey about 3 years ago, and it took me a while to kind of really build into that foundation and really start to build up what I do now. But I've learned a couple things along the way, and I want to talk about that in today's video. So the first thing is chasing hype, buying single stocks. With a lot of my friends and just people that I see on the internet, they tend to think that they can buy the next hype stock, the next Nvidia, the next Netflix, the next, Microsoft. They're going to somehow pick the next winner. While there can be some consistency in companies, when you're dealing with a single stock, it's pretty volatile, and on top of that, you're also limiting your growth. Quite frankly, a single stock can only go so high, but the market as a whole will always go higher. The mistake I'm seeing is buying the trendy stocks, the crypto, things like that, you got off of TikTok or your friends are getting, and you have kind of like a fear of missing out. Stick to index funds, ETFs, things like that, the S&P 500, VTI, things like that, because it's a long-form proven way to actually build wealth through the stock market. Single stocks can add a little bit of spice, but they're not the full meal. And so specifically, if you're trying to build a giant portfolio that is very well diversified, single stocks are not going to get you there because you have to keep up a lot with the company. You have to know what's going on. And personally, I don't want my account or my portfolio to be literally dependent on who's the CEO and how is the market going and how their profit shares are going. I just want to put my money in, let it grow and let it build as I continue to go out and get more dollars to put in my army to build for more wealth. That brings me to point number 2. Inconsistent investing. I like to think of investing as training. And so for me, I've noticed that when I am training, if I'm training 4 days a week, but I'm going every single week, I'm going to get so much more out of that training period than if I go really, really hard for one day. I don't do anything for the rest of the month, but I go really, really hard for one day, and then I just die off and I expect the same result. You're only going to build it brick by brick. And so for me, a way I've fixed that, I've set up automatic investing. I do $600 every single month directly into my Roth IRA. I also have my 401k contributions automized and things like that. And so, autonomous. Consistency will always be better than timing the market. And so if you have that inconsistent investing, you're going to fall short. But that brings me to point number 3, no portfolio balance. A lot of investors, when they get in, they just want to invest. And quite frankly, that's what you're told to do, is to just invest. But you have to go a little bit beyond that. You got to have some balance. For some people, that's going to look like part of it's in their 401k, part of it's in some index funds, part of it might be in their house or some assets or a business. There's a mistake of going all in things like tech or crypto. People just tend to jump right into whatever is hot right now, and then they kind of die off. Having no portfolio balance is going to leave you high and dry when that market tends to dip. There are going to be ebbs and flows because sadly, we're not investing to then take out in a few years. We're investing for the long haul. And if you're my age, that's going to be like 40 years, maybe even longer. We want to use the total market funds and rebalance our portfolios to make sense. So diversifying across sectors, across countries, it's really going to help you in the long game. My international stocks are doing slightly worse right now than my US equities. That's just par for the course with everything that's happening in the US market and all the equities and everything like that, tariffs, everything that's going on. My US equities are going to outperform international, but I'm still seeing international going up. Throughout time, the international is going to outperform the United States a little bit. Overall, my portfolio, I'm working every day to continue to keep a balance of cash to investments in whichever portfolio I want to be in. And eventually I want to get into a little bit of real estate, things like that. So as I've said many times on this channel, we're in the age of information. If it is important to you to balance your portfolio, go to things like ChatGPT, go to things like YouTube, find the information. There's not exactly one right answer on how you should balance your portfolio, but what is important is that you at least continually improve. That brings me to point number 4, which is not trying to time the market. One thing I've noticed is the taco strategy. Trump always chickens out, not to get political, but the president's actions do impact the stock market. There are people waiting for their investments to time the dips for when Trump makes a tariff decision. Part of that might work. I don't want to tell you not to invest because, as I said, I want you doing it consistently, and sometimes that consistency just might line up. Dollar cost averaging over the long run is probably the better play. And I want to be clear, I'm not saying, if the market goes down, throw an extra 1,000 in and move on with your life. What I'm saying is don't try to time the market in the sense of taking all your money out right before you think there's some political tension or tariffs or some big economic thing is going to happen, don't take your money out expecting there to be a dip to put your money back in. Time in the market always beats timing the market. That brings me to point number 5, and quite frankly, this is the most important one. This is the reason I do YouTube. If you do not know what you're investing in, please do not invest yet. Blindly following influencers or friends or family, it can be risky. There are some people that are worth trusting, and I understand that there is a level of, I trust this person, so I'm going to make this decision. I get that, but learn the basics. What is an index fund? What is an ETF? What is a mutual fund? What is a Roth IRA? What is a 401k? What's the difference? Why do I need to know that? If you don't understand it, don't put your money in it. If you don't know what you're doing, that's totally okay. As I've said, we're in the age of information. Ask away. Ask YouTube, ask GPT, ask Google, anything. There are thousands of videos, and I'm about to add a few more to that roster. What's important is knowledge. And if you know where your money is going and how it works, you're going to build a lot more just based off of that than trusting someone blindly. Anyway, guys, thank you so much for watching today's episode. If you guys have enjoyed, drop a like and comment down below what I should talk about next, and I'll see you all in the next one. Adios.